Hi everybody, welcome to another A2 Micro Revision webcast, and in this session we're going to be looking at some aspects of the economics of monopoly power in markets. It's important to define first of all what we understand by monopoly, and that's at A2 there are several definitions or several interpretations of the concept. I'll try and take you through them in the next couple of minutes, and for each I'll give you a real-world example so that you're familiar with the kind of data and the kind of industries that examiners are keen to set you as questions. So at one extreme, we have something called a pure monopolist. That is when one firm is the dominant supplier in the market. In fact, they could take the whole market. And if that was the case, we'd call it a 100% concentration ratio. In that situation, the business is the industry. The firm or the monopoly and the industry are one and the same thing. Now, in reality, it's a little bit like perfect competition. It's a theoretical market structure. It's unlikely we're going to get to 100% market share. It can happen, but so we sometimes have something called a near pure monopoly. Perhaps the best example around at the moment is Google. I had to search for this chart. So I used Bing, obviously, but no, I didn't. But Google has a 90%, effectively a 90% market share in the UK. Notice I put in red there, in the UK. As I'm going to say in a few minutes, that the context matters when you're given some data. So if you're given a question on monopoly, it's always worthwhile in the exam thinking, well, what actually is the market I'm being asked to analyze and evaluate? This chart shows the percentage market share of Google since the turn of 2013, the last couple of years or so. And you can see it's pretty rock solid at just a shade under 90%. That is pretty close to being a pure monopoly. Just at the moment, the European competition authorities are investigating Google for some aspects of their conduct. Now, the reality is that in most industries, in most markets, we don't have pure monopoly, but we do have monopoly power. In the UK, the Competition and Markets Authority, CMA, which you'll remember took over from the Competition Commission a couple of years ago. They argue that a firm, any business with greater than 1/4 of the total sales in an industry is given the term a working monopoly. They're effectively a monopolist in their own particular sector. Here's an example, the fierce battle for market share in the mobile phone industry, the handset market. Again, here's the context. This is June 2014. It's a snapshot. It's only for the UK, but notice here that Samsung has a working monopoly in the industry. It's overtaken Apple. Apple is pretty close to 25% as well. Nokia 17%, but falling. And then we get into the also rounds, including HTC. And by the way, if you're a BlackBerry user, you might want to close your eyes for a few seconds while you look at this chart. Research in motion way down now, less than 4%. Now, this is effectively a working monopoly, but of course most A-level economists would call it an oligopoly. The 5-firm concentration ratio is over 80%. But effectively it's a working monopoly for Samsung. But this is an industry which is contestable. Of course, there's fierce competition for market share. So even though Samsung is a dominant firm in this sense, it's clearly not the only one. Another interpretation of monopoly is what the CMA call a dominant firm. This is any business that has at least 40% of their given market. Now, from the previous example, we know that Samsung isn't there yet, likely to be there for a little while. Here's an example of a dominant firm. This is Coca-Cola, and this is their market share over the last 10 years. Just in the United States, this is their share of the drinks industry in the biggest consumer market in the world. What is striking about this is the stability of Coca-Cola's market position, hovering within 42 to 43%. It is remarkable, and that gives us a flavour, if you like, of the kind of barriers to entry, the challenges that face new firms as they try and challenge the dominance of Coca-Cola and also businesses such as PepsiCo. So we've talked about a pure monopoly, we've talked about a working monopoly, we've mentioned a dominant firm. Effectively, any business which has a downward sloping demand curve is able to have a degree of price setting power. So when we talk about monopoly power in a market, essentially we're really talking about market power. And you don't necessarily have to be a monopolist to enjoy some monopoly power when you're setting your price. And here's an example. This is the global market share for express courier services. And I guess that certainly 3 or 4 of these businesses will be pretty familiar to you. UPS, FedEx, Deutsche Post, DHL, TNT is there. Now this is, notice here the 5-firm concentration ratio is less than 60%. And 60% is a kind of benchmark for oligopoly. UPS a shade under 20%, FedEx just a shade under 15%, Deutsche Post about 10%. So taking those 3 firms as a whole, they've got well over 40% of the market. Each of these businesses clearly has market power. They are globally scaled businesses. And whilst they might face a lot of localized competition, if you take the global market as a whole, these are significant players. And they have, in that sense, monopolistic powers. Here's another example. The reason I want to show you this one is because there's a lot of interest in renewables, in particular, the building of and the installation and the energy created from wind turbines. This is the market share of the manufacturers of the turbines. Vestas, a Danish company, is ahead of the game, and Siemens is a close second. What's interesting here from a kind of macro viewpoint as well is the rise of China as a manufacturer of wind turbines. So there's less significant monopoly power here. This looks like a fairly contestable market. This is the global market share, and clearly you might well have a local or regional monopoly in a particular market there. And here's another example. This is one that's been used by examiners in the past. They're quite fond of asking questions on car making for some reason. VW actually just now has a working monopoly in the European car market, just over 25%, and then some very familiar multinational companies falling in behind. Essentially, the European market, it looks to me as if it's fairly contestable, but clearly each of these businesses on their own is pretty huge. Their market share, however, is relatively low. So what are we saying? We're saying that monopoly power depends, in part, on how we define the scope of the market, in other words, what product are we looking at, and the size of the market. What dimensions are we considering? It makes sense to evaluate monopoly on a case-by-case basis. So when you're given some data on monopoly, have a think about whether it's global data, national information, or is it regional, or even local. And think about whether it's an industry you can break down by a segment. So a very favourite industry at the moment is postal services. The Royal Mail lost its monopoly on delivering letters a few years back. It still has a significant market share, but it does face now a little bit more competition. But are we looking at letters, or are we looking at parcels, much more competitive, or are we looking at postal services as a whole? The water industry is another good example that examiners often choose, and here we see lots of regional monopolies, Thames Water being a good example. And even in something as topical as the pub industry, and after this presentation you probably need a drink, think there about the distinction between maybe a rural area, a village with just one pub, local monopoly, compared to an urban area with perhaps 15 or 20 wine bars and pubs and hotels, where there's clearly a lot more competition. Monopoly depends in part on how we define the market. So let's move on. What are the key features of monopoly? Well, we've already said that monopolistic firms have some price setting power. They face a downward sloping average revenue curve, therefore the marginal revenue curve will be twice the gradient, half the AR curve. Monopolists can price discriminate. They can charge different prices for the same good or service as they segment the market. Crucial point is that a monopoly can set the price or the quantity. They can't set both. So in that sense, the monopolist is always constrained by the demand curve. In a monopoly, there are barriers to entry. And if you check out a recent revision webinar on barriers to entry. It's on the YouTube channel. There's loads of good examples there. And typically we assume that in the market there's imperfect information. Consumers don't necessarily know the prices and the products that all the suppliers are offering. We assume in the analysis that follows that monopolists aim to maximize profits. That's a central assumption. Of course, they don't have to, and the actual decisions about price and output of firms with market power may vary. Firms may choose, for example, to satisfy us instead of maximizing their profits. Sometimes there's an overlap between monopoly and oligopoly, and in an exam it can be quite hard to make a decision. But once you've made that choice, stick with it and focus on how the decisions are likely to be made. So let's look at the diagram. This is the standard monopoly diagram, and it's certainly one that it's worth practicing time and time over until you can get it exactly right, accurately and neatly, and you can do it really quickly. It'll save you time in the exam, and you'll get good analysis marks. So this is the profit maximizing output for a monopolist. They choose an output where marginal cost equals marginal revenue. That allows them to sell at price P1. If we bring in the cost per unit using the average cost curve, we call that C1, we can see here that the monopolist is charging a price well above the cost, and therefore they're able to make quite a high level of supernormal profit. This is the standard monopoly price and output diagram, and it's very important you become confident in drawing this kind of thing in your exam paper. One of the ways to twist and improve the analysis is to say that the ability of a monopolist to charge a high price depends on the elasticity of demand. And if the monopolist, for example, a utility provider, has an inelastic demand, PED is less than 1, then there is even greater scope for making higher profits. So I've just changed my diagram here a little bit. It should look familiar to you. I've just made the demand curve slightly more inelastic and shifted it further to the right. I've tweaked the cost curves a little bit, but you get the same idea here, that the profit maximizing output, Q1, is at a level. You can charge a price P1, the cost is C1, and the gap between price and cost is significantly high. So with an inelastic demand, the monopolist can extract, if you like, the consumer surplus and turn that into monopoly profit or supernormal profit or extra producer surplus. This is the diagram analysis that we're really looking for in the exam. Now, if a monopoly makes supernormal profits, the really key question for you to analyze is how they protect them. And this brings us straight on to the idea of barriers to entry in a monopoly. Entry barriers are anything which basically blocks the profitable entry of new firms. And if those entry barriers are effective, they allow the existing firm, the business with market power, to continue to enjoy supernormal profits in the long run. It's a key point. Short run, long run distinction. Barriers to entry essentially make a market less contestable. And we have a separate revision webinar on contestable markets. Just type in contestable markets into our YouTube channel. Here are some examples of entry barriers in a monopoly. There are many different ones one can look at, and typically students have got lots of good real-world examples of entry barriers. Perhaps the biggest one is that the existing firms can exploit economies of scale. They can bring down their unit costs as they grow in size, and that makes it harder for new firms who are perhaps a bit smaller to break into the market. Monopolies may also protect their profits by gaining greater control of the supply chain, either by going backwards towards their suppliers or by going forwards towards controlling the consumer, the retail platforms. We call that vertical integration. Monopolies may also spend huge amounts of money on marketing, advertising, and other forms of promotion to build significant brand loyalty for their products. And if consumers have that loyalty, in technical terms, this means that the cross-price elasticity of demand will be less because consumers regard the monopolist product and potential rivals as less close in substitute terms. So the big global brands, the Apples, the Sonys of this world, the Samsungs, they build brand loyalty because they know in the long run that's going to help maintain their monopoly profits. Intellectual property, ideas and processes can be protected by things such as patents. That allows a firm to control key technologies that the rival firms may not have access to. And crucially, businesses in the market, as they build up their monopoly power, they learn by doing. They build up expertise, human capital, they build up a reputation, they accumulate consumer goodwill. And actually, the bottom right-hand down the chart here, expertise and reputation, that can be one of the biggest barriers to new firms to break into a market. The existing firms have gained an advantage by getting in there first and being successful. So barriers to entry are a way of protecting long-run monopoly profit. Now we come to look at the extent to which monopoly is a cost to economic efficiency. And as I've said before, as our graphic shows here, you have to judge monopoly on a case-by-case basis. Sorry about the image, couldn't contain myself. What is the economic case against monopoly? This slide takes you through some of the key arguments. I think the first essential point is that if we compare monopoly with competition, it's likely that the monopolist is going to charge a higher price than you would expect if there were many firms competing for people's purchases. And if the price a monopolist charges is well above marginal cost, then that leads to a loss of allocative efficiency. A key point often missed out by students is the impact of monopoly on incomes of the purchasing power of relatively poorer households. If the monopolist is charging a very high price, lower income families will find it hard to be able to afford the goods and services on offer. You could argue, therefore, that monopoly can actually have quite a regressive effect on the distribution of income. Second argument is that the absence of genuine day in, day out market competition can actually lead to some inefficiencies, a loss of productive efficiency. Monopolists may spend huge amounts on advertising and marketing, which may actually not really be needed. Their fixed costs tend to rise. They have big head offices and expense accounts and very high levels of managerial inefficiency. A famous quote from an economist in the 1930s that the best of all monopoly profits is a quiet life, that firms with monopoly power can just keep churning out the revenues and the profits without really doing too much. So perhaps the final quality of the good or service to the consumer may deteriorate. This links on to the next point, that if you have essentially a protected market, then there may be less genuine drive to innovate. So the cozy monopoly theory that's often expressed there. And you can bring in a relevant concept here that if the monopoly goes too far, becomes too big, it grows beyond the optimum size, then they may suffer from diseconomies of scale. Profits in monopolies can certainly be very high. Here's a good example. This is one I often use with my own students to look at the rate of profit of the leading pharmaceutical companies in the world. Pfizer, a United States company, and Roche from Switzerland, AstraZeneca and GSK from the UK. These are high rates of profit. This was for 2013. So I think a really good example to take for your notes is that Pfizer made an operating profit margin of 43% in 2013. I mean, there's serious money to be made from pharmaceutical businesses. This is a diagram which tries to explain how you can build a case against monopoly. On the left-hand side is the long-run equilibrium in perfect competition. P1 is established in the long run as the entry of new firms causes the market supply to shift out and the price to fall to an equilibrium where firms make just normal profit. However, on the right-hand side, we go back to our old monopoly diagram again, and the price P2 is well above cost, It's well above marginal as well as average cost, and there's a loss of efficiency. So I think in the exam, don't be afraid to draw yourself a good analysis diagram and make a point about efficiency and consumer welfare. You certainly get the credit if you do that at A2. There's the profit from the monopolist charging price P2, well above C2. What about the counter arguments? The first point I've put in blue here on this slide because I really want to emphasize it. Sometimes you get data in an exam question which shows clearly there is a monopolistic firm, and you're kind of half expecting the question to be consider the case for and against monopoly, or how could you intervene in the market. The high level of market concentration, so say for example 2 or 3 firms dominate the market, that does not always signal the absence of competition. Oftentimes monopolies are monopolies because they are the best of breed. They have proven themselves to be the most effective, successful, efficient firms in the market. I suppose one could argue that Google's success is evidence for that. Maybe Coca-Cola as well. What are the key advantages of monopoly? First of all, the profits have value. Producer surplus can be used to fund investment in capital and research and development, and that can have quite important externalities in terms of knowledge spillovers and social benefit from, for example, the emergence of new drugs and new processes. In some industries, and we're going to do this as a separate webinar, but in some industries there is a natural monopoly element. The economies of scale are so large, so significant, there's probably only room for one firm to fully exploit the internal economies of scale. Third point is actually quite significant. It's a good one that students often make. So you might have a domestic monopoly at home, but actually they face in the global market significant competition. And it's the trade within the world or the regional markets, which is actually the dominant factor. Fourth point is that if you don't like the outcome of a monopoly, you can regulate them. A regulator can act as a proxy consumer, for example, by introducing some price capping. We're going to do price discrimination as a separate webinar, but price discrimination is a tactic, a strategy that many monopoly firms practice, and in some cases that can actually help some consumers, particularly those who get charged a lower price for a particular service. Here's my example of pharmaceuticals again. We know that many of these firms make significant profits. I mentioned Pfizer before and Novartis, but notice here how significant is their research and development spending. So Pfizer in 2013 spent over $6 billion on R&D. Novartis spent just shy of $10 billion on research and development. One way of revising monopoly is to use the Monomic SPW. So this is a good way of looking at monopoly and efficiency. S stands for service. So does the absence of competition actually affect the quality of service to consumers? P stands for price. You can compare competition and monopoly in terms of price and output. Bring in the concepts of efficiency, productive, allocative, dynamic, and finally make a comment on welfare. Overall, do you think a monopoly is good or bad for the welfare of consumers? So perhaps SPW can be a factor in your revision when it comes to this important topic. The key point I want to make is that profit of a business does have value. Although the monopolist may be able to extract consumer surplus and turn it into producer surplus, that producer surplus potentially has value. Of course, it depends on how that money is used. This chart is something that I won't have time to go through fully with you on this revision webinar, but you'll be able to go through it in the YouTube version. It basically compares and contrasts a monopoly with a contestable market. And there's a separate revision webinar on contestable markets. Just type that into our YouTube channel. The crucial point really is that a contestable market can have any number of firms. Usually a lot of firms with a fairly small concentration ratio. But in a contestable market, the entry and the exit barriers are low, and the threat of competition affects businesses every much as the existing competition. With monopoly, there are barriers to entry and exit, which essentially protect the market power of the existing firms. Just a quick word on Jean Tirole. Jean Tirole won the Nobel Prize for Economics in 2014. And it was an interesting award because this was largely on the back of many, many years of superb research and analysis on monopolistic markets. He studied markets in great depth, and his argument, which I think is worthwhile for your A2 exam, is that sometimes it's best to leave monopolies alone. Perhaps there's sufficient competition in certain parts of their industry, or perhaps any form of regulation might not actually work. So Tirole's argument is that you have to look at individual markets on a case-by-case basis to judge whether a specific intervention is worthwhile or likely to be effective. You can't have a blanket view or a one-size-fits-all approach to monopoly. I think that's an important part of A2 evaluation, is to think in those terms. How can governments intervene? There are many, many options. Again, I'll cover this briefly. We'll do some separate webinars on regulation and competition policy. One option, if monopolies are making high profits, is for the government to introduce a tax, maybe a windfall tax on the excess profits. That's happened in the past, for example, with oil and gas in the North Sea, and more recently with the banks, the monopoly profits of the banking system. The danger with that, of course, if you have a one-off tax or any extra tax, is that the monopolies will try and find some way of avoiding it, and there may be a downside effect in terms of less profit for investment. Long-term policy would be to think about how monopoly power could be broken up, how you could possibly deregulate or liberalize a market to provide an opportunity for new smaller firms to break into a particular sector. That's an important supply side policy. Of course, the issue is whether there are sufficient small businesses queuing up to try and break into a particular sector and then be able to compete. We'll do price capping in a separate webinar. This is, for example, where in the utility industries, the industry regulator may set a price capping formula designed to hold consumer prices down as if there was more competition. Good example there is the price cap on the roaming charges set by mobile phone companies as you move from one country to another. Another good example is the cap on interest rates in the payday loans market, which seems to have had quite a big effect. The evaluation point is that monopolists, if they find their revenues and profits capped in one way, will try and generate extra revenue in other ways. The other option, I suppose, is to think about state ownership. Certainly many people on the left of politics think that certain key industries with monopolies, for example in transport, they're better off in the long run with a different set of objectives and different ownership. So the case, for example, of taking the railway industry back into state ownership. And that raises interesting questions about the relative efficiency of different types of business under different ownership regimes. But monopoly, we're saying you judge on a case-by-case basis, and there are lots of intervention options, and I'm sure you'll find some examples in your revision of how those work. So this has been a revision webinar on aspects of monopoly power. We haven't covered price discrimination. We're going to cover that in a separate webinar. And we haven't covered barriers to entry because, again, we're going to look at that in a different revision session. But I hope you found this useful, some good examples to put into your notes, and the key diagrams which I'm recommending you practice till you know them really well. Thank you for joining us on this revision webinar, and we look forward to seeing you again sometime soon.